All right, today we're cracking the code on something that pretty much powers our entire economy, credit analysis. We're going to pull back the curtain and see exactly how lenders figure out if they should, hand over the money. Let's get right into it. So to kick things off, let's put you in the lender's seat for a second. Imagine you're about to loan a ton of cash to someone, maybe a friend starting a new business. What is the one single question that's just screaming in the back of your mind?
You got it. It's this. Will I get my money back? That's the whole game. At the end of the day, everything a lender does, all the spreadsheets, the meetings, the coffee, it all boils down to answering that one super important question. And the entire field of credit analysis? Well, that's just the methodical way they find the answer.
So how do they find that answer? It's definitely not just a gut feeling. It's a really structured process. It's all about asking the right questions to turn this big, scary uncertainty into a risk they can actually calculate. Okay, first and foremost, can the company generate enough cash? And I'm saying cash for a reason. Forget about profit on paper for a minute. You can't pay back a loan with an accounting entry, right? It's all about cold, hard cash. Cash in the bank and a steady flow of new cash coming in from, actually running the business. Next up, the analysis has to be looking forward. Sure, the past is interesting, but lenders get paid back in the future. So what they really want to know is how the company is going to hold up when things get ugly. What happens if the economy takes a nosedive? Can they survive a serious recession?
And this is where the rubber really meets the road. The whole goal here is to put a number on the risk. First, what's the actual probability of default? The statistical chance the company just can't pay. And second, if that happens, how much of our money do we really lose? That's what analysts call loss given default. It's the real-world financial damage in that worst-case scenario.
So, how do analysts even begin to answer these huge questions? Well, interestingly enough, it's not just about crunching numbers. It's about building a narrative, a financial story, if you will.
This quote absolutely nails it. A great analyst isn't just some human calculator. They're a storyteller. Think about it. Are a company's sales flat, but their profits are soaring? Well, the story there is about incredible cost control. Are they generating a ton of cash? The story is what they do with it. Do they pay down debt? Or do they reinvest for some kind of explosive growth? That's the story.
And this right here shows you exactly how that story gets built. It's a logical flow, a step-by-step argument. You start with the big picture, the industry. Then you zoom in on the specific business risks and, crucially, you assess the management team. Only then do you really dive into the financials to build out that story, which leads you to a risk rating and finally, a crystal clear recommendation.
And this is what it's all building toward, the integrated financial story. It's the narrative that connects all the dots. It doesn't just tell you what the numbers are, it explains the why behind them and gives you a really good idea of where the company is headed next.
Okay, so the analyst has built this really compelling story. Now what? How does that story actually translate into a real-world financial decision? Let's take a look at how it shapes the final terms of a deal.
Now, a super critical part of this story is how the loan is going to get paid back. The primary source is the healthy one. That's the cash that flows from the company's main business operations. The secondary source, well, that's the emergency backup plan. We're talking about selling off equipment or having to call a guarantor to cover the debt. Lenders always want to be paid back from that primary source.
And the result of all this work isn't just a simple thumbs up or thumbs down. The analysis is used to price the risk. A riskier story means you're going to pay a higher interest rate. It's what determines if the lender needs collateral, and it shapes the entire structure of the loan itself.
And don't think this is just for one specific type of loan. This exact same fundamental process applies across the entire universe of debt, from a simple working capital loan for a small business all the way up to massive corporate bonds that are traded on the global market. The core questions are always the same.
So this is clearly a powerful framework, but, it's not foolproof. Like any tool, it's got its strengths, but it also has its weaknesses. Let's get to the bottom line on this.
On one side of the coin, the benefits are obvious, right? It measures performance over time, it shines a bright light on potential problems, and it leads to disciplined, data-driven decisions. But on the other side, it's got some real deficiencies. For one, it's fundamentally based on old numbers, on stuff that's already happened. And if an analyst gets too buried in the spreadsheet, they can completely miss vital things you can't quantify, like a toxic company culture or a brilliant new competitor on the horizon. They can, quite literally, lose the plot of the story.
Which leaves us with this final, really thought-provoking question. Financial analysis gives us all these powerful tools to look at the past, but at its heart, it's an attempt to predict the future. And in a world that is constantly changing, how do you truly accurately price what's coming next? That remains the ultimate challenge.